All right, with tax planning, really, I mean, obviously it's a broad topic, but what we really want to talk about in understanding what tax planning is really figuring out what it's not. So, really, when we talk about tax planning, we are talking about maximizing. So this is like a maximum function, the cash in your pocket. Okay, we are not minimizing the tax that you pay. Okay, very, very important to do. If you want to minimize the tax that you pay, here's how. Just simply earn less income. Okay, so we've talked about this before. What we really want, so if you want to get this into really what we're doing, is we are minimizing tax, but conditional on the income level. Okay, so this is the famous, if you've done any probability theory, this is the conditional symbol, and it's very important. So if you want to talk about, tax planning is about tax minimization, it is, but conditional on the level of income. It's not just pure, I want to pay the least tax. Okay? So then let's talk about some things that planning is, related to, but not the same. So the first is this idea of compliance, and really, in this course so far, what we've done is compliance. We've learned the law. So this is the tax treatment of a transaction. Okay, and so we've done lots of that. What planning is, at least in my mind, is again conditional. Given the tax treatment, can we find, are there alternatives? Are there alternatives to the transaction? So we'll just call it, we'll personify it. So this transaction, are there alternatives to it to consider? So basically, is there a way for us to do what we need to do in a different way, given the tax law, that would get us a different and hopefully better tax treatment? Are there? If so, then we can do some planning. The second thing is planning is not tax evasion. Okay, so this is really a spectrum when avoidance becomes evasion, but here in my mind it's pretty clear. Evasion is lying. Planning is not lying. Okay? And again, I have this way that I think about it that hopefully may be helpful to you, is when you're just planning, you're actually altering the facts. Meaning not that you are lying, you are altering the facts, meaning you are choosing to go left instead of right. That's a fact. The fact is we went left, we didn't go right. When you're evading, you're not. You don't alter the facts. What you try to do is you try to say, what the facts are actually different than they are. And so what I'm going to do is I'm going to alter the story that I'm telling you, but I'm not actually going to alter the facts. Okay? Really important to note here, as I note in the slides, and we'll come out in class, the ethics and the legality around these things is really, really important. In our role as professional advisors, we really have to think about these things when we're advising clients. And obviously clients are going to want to pay less tax. That's their bias. But we have to think about the ethical and really most importantly the legal elements to the advice that we give. And we never want to tread near the line where we're telling people or helping people to evade tax. Okay, so hopefully that'll come out a little bit in class. So the question then is how to reduce tax payments. So how do you do that? How do you reduce taxes through planning? Okay, it's easy to figure out how you do it through evasion. You just lie, right? And you say, hey, I didn't have income, therefore I'm not paying tax. Okay, and unless there's some mechanism in place to prevent you from doing that, you can get away with it. But trust me, we have lots of mechanisms. So let's just remind ourselves that when we go to calculate the tax to be paid, it's a pretty simple formula. It's a rate, the tax rate, times what we call the tax base. And in our minds, that's just income. Okay, so when you think about how can I reduce taxes, you have two choices. You have the rate and you have the base. And for the most part, the rate is going to be stuck. The rate is going to be set by statute, and there's not a whole lot you're going to be able to do about it. So most of our planning is going to be looking at the base. Can we get income into the hands of a taxpayer that pays less? So the first thing, that has a lower rate. So one thing we do want to think about, although as it turns out, it really is not very effective, but if we can actually delay the payment of the tax. So if there's some way for us to get this, we may get some time value of money benefit out of this. But this is kind of shut down. So I'm going to put a big X here. This is really shut down by withholding taxes and installments. So the government of Canada is pretty good at getting its money sooner rather than later through withholding taxes and installments. And so you really don't gain a whole lot here. So the bigger ones, though, are really all fall into one big category. We need to alter the tax base. Basically, we need to go in here and say we want this to be different than it is. So one way we can do that is, if it's possible, and again, we're not lying, if we can structure our things in such a way that our treatment will be capital treatment rather than income treatment, then right there we reduce our tax base by a half right away. Secondly, we can shift, and we'll talk about what that means, but we can shift the income to taxpayer with a lower rate. And if we have common ties with that other taxpayer, then we will win as a group. We will pay less tax. So again, this was like that income splitting in the case. So when we talked about Claire paying Phil, we had that whole thing come up. So that's income splitting. Basically, Phil had a lower tax rate. It's also when a corporation, so a foreign subsidiary, if you have a foreign sub in Bermuda, where they pay no tax, 0% rate, then if you can get income to be taxed in their hands rather than in the Canadian parent's hands, you win. Now, obviously, there's going to be a lot of things stopping you from doing that because Canada will lose tax revenue. But if you can do it within the bounds of that, then absolutely you can save tax. And then the last thing is that we can shift to a time period that has a lower rate. Okay, so the most common of these to think about is the RSP. The RSP is basically, so again, let's remind ourselves before I get to that. We want our expenses in a high tax year, sorry, not height, in a high tax year, and we want income in low. Okay, so if possible, we want that to happen. There's nothing preventing that from happening, unless of course there are things that preventing that from happening. For the most part, though, when tax rates are steady, there's not a whole lot you can do here. But the RSP is a good example. When you have a high rate when you're working, you can not have that included in your income, and you withdraw it when you retire at a lower rate. That's great. Secondly, things when there are tax rate changes. So whether you're aware of it or not, Canada has actually been lowering its corporate tax rate over the last 10 years. And as that has happened, there are planning opportunities. If you know that a tax rate change is coming and you can change your behavior, so delay the shipment of something to a customer near the end of a year, you can save real dollars in tax. Okay, so this is not necessarily deferring them, this is actual savings because they will be taxed at a different rate. Okay, so the problems we'll look at in class will bring out some of these things. There's this balance between the shifting of the income and the time value of money that always needs to be considered. The opportunities to do this are not huge, so what we want to do is we want to understand the basics of it so that we can understand how it works, and then see what we can do within the bounds of the law.